Thank you for coming. It's really a pleasure to have you here today. I'm Reed Kramer of the New America Foundation. I direct our asset building program, and I'm very pleased to welcome you to this event today entitled Advancing Economic Mobility Through Savings. And with this gathering, we are relaunching the Congressional Savings and Ownership Caucus, and also taking the opportunity to highlight a new report put out by the Economic Mobility Project of the Pew Charitable Trusts. And the report examines the links between savings and economic mobility, and also the policy obstacles that must be overcome to really strengthen those links. In the run-up to last year's financial crisis, as that unfolded, we already knew that the personal savings rate had dropped to historic lows. We also knew that consumer credit had skyrocketed, and this is really a precarious combination. So when the recession took hold, it seemed that initially, maybe this problem was just going to self-correct. People were going to kind of pull back on some of their consumption, and they often do that when faced with economic uncertainty and the prospects of job loss. True to form, personal savings rate did reach over 6% in May, the highest level it had reached since 1995. And yet by August, it had dropped back down to 3%. And that's really a signal that we can't assume that a more responsible era has already dawned. There's really a lot more work to be done, and it's going to take a concerted policy effort. Still, I think that there's promise that this effort is already underway. We've heard the President talking about the need to create a strong foundation for growth and prosperity, and that means moving from an era of from borrow and spend, the previous era, to one of saving and investing. And then recently, Tim Geithner, Treasury Secretary, talked about how this is going to be a different kind of recovery because it's going to be one where Americans are going to have to save more. So the recession for some has converted people to a new era of thrift, maybe in the short term, but we really can't squander the opportunity of putting in place some new protections, new policies that encourage saving for the long term, help people weather economic uncertainty, but also provide that springboard to help people move up the economic ladder. And since 2005, we've been very pleased to work with a series of lawmakers who have been dedicated to raising awareness about the importance of savings, the importance of expanding ownership of assets and wealth, and also the role that financial education plays in people's lives. And all these lawmakers have recognized that savings plays a crucial role. It's a key to stability, opportunity, and yes, even mobility. So it's a real important foundation for economic growth over the long term. So today we really want to commend the leaders and their dedicated staff who are also here today for relaunching the Congressional Savings and Ownership Caucus for the 111th Congress. And in the House of Representatives, they've been led by their co-chairs, Representative Jim Cooper from Tennessee, Thomas Petri from Wisconsin, and Earl Pomeroy from North Dakota. The three of these members have long been leaders in heading up the caucus since 2005. And this year they're joined by Representative Joe Pitts from Pennsylvania, and his staff, Ben Stoltzfus, is here carrying that office's banner. And really, they've been long leaders in this field. They're co-sponsors, along with Representative Pomeroy, of the Savings for Working Families Act, which I think Ben passed around some material on. But all four of these offices are committed to working across the aisle to promote increased awareness on savings work, especially for families with fewer resources and lower income. So there's much work to be done, but there's sign of progress, and there's sign of really digging in for this work going forward into the next year. Full agenda. So I'd like to introduce Representative Cooper to say some remarks. Then we're going to turn it over to John Morton, who is at the Economic Mobility Project. He's the Managing Director of Economic Policy at Pew, and then we're going to talk about the report. But Representative Cooper has represented Nashville and the surrounding areas since 2002. That's the 5th Congressional District of Tennessee, and for Representative Cooper, this is his second time around. He actually started serving in Congress at the age of 28 and served till 95. He's an attorney, he's a Rhodes Scholar, And he's really, almost more importantly, an expert in fiscal policy and healthcare reform. So this is a member who's been kind of busy lately, but he's long been a champion of savings, and we're very happy to have him here. He's been a co-sponsor of the Aspire Act, a bill that would create a children's savings account for every newborn child in America, and thinks a very promising proposal. And I also hear he's a pretty good banjo player from his staff, which may not mean a lot to you guys, but in my family that's actually a pretty big deal. We're surrounded by banjo players. Anyway, let me turn it over to Representative Cooper. Thank you.
Thank you, Reed. I appreciate that kind introduction. It's a pleasure to work with my colleague Earl Pomeroy, Tom Petri, Joe Pitts, to relaunch this very important effort. Savings and ownership are two of the fundamental bedrocks of America. And sometimes we need to remind our constituents and citizens of this fact. The recession has helped us remind them. That's an unfortunate way to do it. But we're looking at a number of policy options that help encourage thrift and ownership. I want to commend to you this new report about upward mobility and savings. That's a connection that so often we do not make. Upward mobility is the American dream. And how do we help more people attain that dream? There's some fascinating nuggets in the report. If you have a parent or parents that are future-oriented, that gives you a much greater chance as a child, even if you're from a very low-income household, to get ahead. So that's really the key. It's the orientation of your parents toward the future, as evidenced through their thrift behavior. Are they saving for that rainy day? Are they preparing for that unfortunate event? And those families that are, give their child a much more solid foundation to grow. There's some other wonderful nuggets in the report. You know, everyone has their own taste and data, as you well know. You are entitled to your own opinion, but you're not entitled to your own facts. And there's some amazing, if not facts, at least factoids in this. For a poor person who borrows $300, $350 from one of these payday lenders, the average amount they will pay to have borrowed that money is well over $700. That's an astonishing thing. $4.2 billion in fees to these so-called predatory lenders that just keep the lower class the lower class. Is that the American dream? I don't think so. And yet so many people don't put the numbers in that simple graphic form. Like sometimes in business school classes they have what's called a dollar auction. And it's designed to find the dumbest people in the class. Who's going to bid more than $1 for $1? Well, you'd be surprised. In the heat of an auction, people do crazy things. Well, in the heat of everyday living, a lot of folks back home are doing some crazy things. Albert Einstein is supposed to have said that the most powerful force on earth is not nuclear power. It's compound interest. When you're a debtor and that's working against you, that is not the right incentive structure for the American dream. Another, I think, marvelous factoid in this thing is the fact that direct U.S. government programs to encourage savings are on the order of, and this is just for, primarily for retirement, $130 billion a year, largely passed on to middlemen, and how much of that actually ends up shifting savings from folks who are already saving, so moves it from one form of savings to another, as opposed to creating new savings. It's astonishing if you look at government programs in an orderly fashion and really try to measure which ones are working, which ones aren't. There are a lot of surprises here. So it's going to be a great policy area, regardless whether you're interested in health fringe benefits or retirement benefits or personal savings or planning on buying a used car or a new home, whatever folks are focused on. The federal government could do a lot better job of making sure that whether it's a direct government expenditure or a tax expenditure, and I rate those two about the same. We need to be focusing on that. There's a marvelous staffer who unfortunately has left the Hill, Ed Kleinbart, who's the head of the Joint Tax Committee staff, who pointed out that now the side pocket jurisdiction of the Ways and Means Committee is $1.2 trillion, the tax expenditure jurisdiction, which is seldom examined. And that is now greater than the entire jurisdiction of the Appropriations Committee, including all 13 subcommittees. So if you put things in order, you see that he calls it actually a Congress within a Congress. And that's an amazing thing, and many members here are not familiar with that approach. It wasn't published in Sports Illustrated, it was published in Tax Notes, which isn't everyday reading. But these are some of the fascinating and amazing issues that are coming up, and let me leave you with this last little nugget. This isn't in the Upward Mobility Report, but it's something I think everybody should know. What is the core business of federal government? When people come to Washington and they look at the beautiful mall and they see the Smithsonian and they see a few nice old buildings and a bunch of bureaucrats. What's the core business of government? You know, the central business question is, who is your customer? Why are you in business? And an astonishing number of folks cannot answer that question. Well, how do we answer that question? Well, at least according to some analysis, the core business of federal government is and has been for many years now insurance, social insurance. Over 70% of federal spending is on that. Retirement, others, Medicare, Medicaid, Social Security, VA, you go down the list, TRICARE. And we don't have an insurance committee. We don't even have an awareness that that's our core business. And at least from a business school standpoint, insurance is just complicated enough where it's really not taught in many business schools, at least not taught directly. And it's just complicated enough, it's a little bit like three-card Monte, and you're moving the pieces around a little bit too fast for the eye to follow. It's just a little bit complicated because so many people view insurance as like the lottery. And you get a good deal if you pay in a little bit and get a big payout. Well, in aggregate insurance, it's not like that. The pay-in has to equal the payout. Some people will pay more, some people will pay less in their receipts. And a lot of folks in the policy world don't want to wrap their minds around that. But I want to thank y'all for being here. I don't see any of my other co-chairs at this point, but we need to hear from the presenters. And I'm on your schedule. They just called a vote, as you heard.
Yeah.
So,
thank you so much for joining us today.
Thank you.
We're going to keep up the discussion. Yeah, Representative Pew was going to be joining us. He's in a markup now. He's also been just a wonderful leader in this work. And if he does make it through during our presentations, we're going to kind of create some space for him to say hello and talk about his work and commitment. But now let's bring up John Morton from the Pew Charitable Trusts and Managing Director of the Economic Policy Wing there, and who's heading up the Economic Mobility Project.
Thank you, Reed. I think my lesson there is if
you come up and we're just going to come up and so we can hear.
If anyone reads the report half as closely as Congressman Hooper has, I think we'll claim the report was a success. He clearly has gone through it and found I think a lot of the great nuggets in the report. My name is John Morton. I'm Managing Director of Economic Policy at Pew, and I oversee the Economic Mobility Project, which worked with New America and several others to publish the report that we have out in the front today. As the saying goes, a penny saved is a penny earned, but the question is, does a penny saved translate into greater economic mobility? And that's really the question that we set out to explore with this report. And the report we're releasing today looks at that question and finds that both across generations, but also within individual lifetimes, greater savings does indeed positively impact economic mobility, particularly for people at the bottom of the economic ladder. Additionally, the report finds, as the Congressman suggested, that there are disincentives in the federal tax code and public assistance programs, and considers how public policy could be changed or considered to be changed to encourage greater upward mobility. And I think Reed and Work will discuss some of those recommendations a little bit later today. Very briefly about this project, I think many of you are familiar with it. We've been around for about 3 years now. We are a very broad and strange bedfellows coalition of principals and advisors from New America, Heritage, Brookings, Urban, and the American Enterprise Institute. We came together under a banner of trying to better investigate the health and status of economic mobility in America today. We didn't have a policy dog in the fight. We weren't trying to prove or disprove a train of thought. We really wanted to better understand what the status of mobility in America was. And we found a really glass half full, glass half empty story. We found that by and large, most families were doing better across a generation. 80% of children were 80% of children born poor were in fact making more money a generation later than they had been born as children. But 42% of those born poor were still in that bottom quintile. We're still at the bottom of the distribution a generation later. So if you're born poor, you do in fact rise with the tide, but you remain at the bottom of the ladder, if you will. And that percentage is about double the percentage found in many other industrialized countries. So we refer to it as kind of stickiness at the bottom. If you're born poor, yes, you rise, but you rise at a much slower rate than the rest of the distribution here. And I think that challenged a lot of our members, right, left, and center, to ask, why is that? We also found great racial differences. We found that if you're born to middle-income African-American families, you have almost a 50% chance of falling from the middle income to the bottom of the income distribution over a period of the last generation. Very troubling findings. Now, why did we focus on economic mobility? Because, as the Congressman suggested, it really is a core American ideal. This question of where you're born, does it dictate where you end up? And that's the question we set out to investigate. We came up with a fairly broad scope of indicators. What are the factors or indicators that determine how one progresses through upward through society? And we divided them into three buckets: human capital, social capital, and financial capital. And we'll be talking later today about some of the drivers in that financial capital bucket, these savings and wealth creation vehicles later. And we found, and the reports today find, I think quite interestingly, that parental savings very, very clearly boost the economic mobility of children, particularly among families who begin in the bottom income, the bottom of the income ladder. Just half of children born to low-income parents that have low savings leave the bottom income quartile over a generation. So let's pause on that for a moment. If you're born poor and your parents have low savings, you've got less than a 50% chance of leaving that bottom rung of the ladder over a generation. Okay? On the other hand, if you're born to that same poor family, but your parents have high savings, you've got almost a 3/4 chance of leaving the bottom rung, holding income constant and holding all else constant. So just that differential rate of savings, now obviously a lot of other things are caught up in that, but just that differential rate of savings is a large predictor of the incremental benefit that you will have in terms of upward mobility. That's a very powerful finding. And the same thing holds true when you look at upward mobility within a generation, so not across a generation, but within a generation. So among adults who were in the bottom income quartile over a period of time in the 1980s, 34% left the bottom if their initial savings were low, compared with 55% who rose up if their savings levels were high. So this finding holds not just across generations, but within generations. And so we think, and I'm sure Reed will say more about this in work as well, that this really does highlight a very strong correlation between savings rate and upward mobility. I'll say one brief word before concluding about the findings within which these, or the setting within which these recommendations are being published. On the table out behind the door, you'll find our project's bipartisan policy roadmap for enhancing economic mobility. We released this about 2 weeks ago, and this is really the culmination of about 2.5 years of work that our principals from these 5 distinguished think tanks came together, knocked heads, sometimes quite bloodily, but came to consensus agreements on 25 recommendations spanning these financial, human, and social capital areas that we believe policymakers should focus more attention on. These are recommendations from early education to strengthening families on the social capital to investing in more savings incentives to worker training, etc. Where we really do believe that that the federal government needs to focus more time and attention if indeed we are committed to enhancing economic mobility for all Americans. And I will say 2 other things about these recommendations. They are done within the framework, or they are recommended within the framework of what we call a portfolio shift. A portfolio shift in 2 ways. The first is that our principals group sees us spending about $750 billion every year on what we call a mobility budget. And this is a very detailed analysis that was led by Gene Sterling at the Urban Institute, focusing on how much the federal government spends every year on economic mobility, $750 billion. So not a small amount of money. But we see that money going largely to middle and upper income families. So it's not a shortage of money, it's a question of where it's being targeted. And we don't call for massive redistributions in the roadmap. We merely say that as we look about where we should be spending money, it's not a shortage of money, it may be a targeting question. And the second area that we highlight in the roadmap, and again, this is a consensus document of our principles from right, left, and center, is that we say that often in policy, we spend money on income maintenance programs which may not do much to enhance economic mobility, which may do a lot to shore up and provide supports for people, but may not do a lot to support the underlying drivers of future economic mobility. And again, a lot more detail about what we mean by that is found in the roadmap, which I encourage you to pick up on your way out. So with that, there are some tremendously interesting and provocative and more substantive recommendations that are related to savings, both in the roadmap and that Reed and Rourke will preview now. Thank you for being here. Please visit us at economicmobility.org, and I look forward to the discussion that will follow. Thank you.
Yeah, I think we're going to, Rourke and I are going to kind of talk about our contributions to the new report that's being released today, and then we'll have some time for a broader discussion. I just also want to say, I'm a big fan of this roadmap document. I think it's very valuable. It was a really intense process. It came up with some very powerful recommendations. My colleague Ray Bashara, who's here, participated. He's the one with the scars from some of those battles, but I think he's healed up except for his foot now, when he's limping along in a cast. And I think it's already been a very useful document. Representative Petri, staffer Rich Markowitz, I think he just popped out, but I think is he back there? There he is. Okay, said that I believe this was him saying that it's already something that's added some value to some of their thinking. If Representative has seen it, and I'm a big fan of some of the recommendations, and this concept of portfolio shift I think is quite powerful. Shifting to where we are today with the report on savings and mobility, the piece on data analysis is really key. It's very significant. It's one of the first that looks at the links between savings and mobility over an extended time horizon. It's state-of-the-art analysis, state-of-the-art data, and it found a very significant effect, both with parents and in one's life chances of moving up the economic ladder if there was a presence of savings, particularly for lower and middle-income families. And so then using public policy to promote savings, appears to be something we should really look at very strongly. And then the question becomes, well, how well are we doing currently? What are the policies that are in place now, and how are they performing? And so when we've done this, leads us right to the tax code, because most of the incentives are already embedded in the tax code. And when we take a look at the various tax rules that are out there, the report actually includes a lot of details about the current rules that are in place and the history of IRAs and 401ks and other tax-preferred accounts. And it's actually, the report's a pretty good reference guide to figuring out what the current policies are. But the bottom line is we've had this proliferation of savings vehicles, but not a lot of new savings. So the report describes 15 distinct savings accounts that are in the tax code, and it's really hard to avoid the conclusion that it's too many vehicles, and we've created a pretty confusing terrain for people to kind of traverse. Not only that, when we give favorable tax treatment to all the deposits that go into these accounts, a lot of resources are being put on the table and really taken off the table in foregone revenue. So Representative Cooper mentioned the figure that's associated generally with savings and tax expenditures and retirement tax expenditures, $130 billion a year estimated for fiscal year 2010, just in 1 year, that's devoted to incentivizing contributions to these accounts. And clearly, it shows we've had some public commitment to these ends, but it really raises the question, are we getting our money's worth? What's coming out of the policy that's devoting this amount of resources? And we go on in the report to assess the current policies. We look at the tax rules that are promoting savings, and we ask 3 questions. Who's participating? How much are they contributing? And what's the distribution of tax benefits among the population? And the analysis in the paper makes clear that how we treat different kinds of savers varies enormously. We find that participation varies. Even though everybody's eligible to participate, only about half of the current workers do. Younger and lower income workers participate at much lower levels. And while the participation rate is around 50% when we look at all workers, the sponsorship rate, people that work for employers that offer savings plans, it's much higher, 67%. So clearly a lot of people are missing opportunities. They're not taking advantage of the savings opportunities that they have before them. We do find that when people work for larger firms, unionized firms, they work in the public sector, their rates of participation and sponsorship are much higher. And I think that that's interesting for policy as we move forward. When we look at contributions, we also see that they increase with income. For 401k type plans, the average contribution for workers between $120,000 a year and $160,000 a year was over $7,400 in 2003. And this was more than double the rates, the contributions for workers earning between $40,000 and $80,000 a year. And for people earning less, between $20,000 and $40,000 a year, they had contributions of about $1,500. So really a big variation as we move up and down the income scale. But most of the benefits, the tax benefits, go to people who are in the upper income households. There was a simulation that was conducted by the Tax Policy Center, and the research is cited in this report, and it's looking at contributions made to 401k type plans, and it shows that the present value of income taxes, the value of that was an average of $528 per household. But it wasn't evenly distributed. Around 70% of the tax benefits for new contributions accrue to the highest 20% of tax filers. And half of the benefits go to those in the top 10% of income. 90% of the benefits go to the top 40%. So people at the lower level, in the middle and the lower level, are getting very little benefits from the current tax rules. When we go on to then assess the delivery of how these savings policies are working through the tax code, you have to conclude that those who have little or no tax liability are receiving little or no incentive from the current policies. And meanwhile, those with the highest incomes are going to receive the greatest benefit. And unfortunately, it's the higher income families that can kind of move money around to take advantages of the tax rules. So we're not even sure if these are new savings, but they're definitely getting the benefit. There's other evidence out there that shows that families with moderate incomes, lower incomes, they're the ones that actually reduce their consumption in order to save. So if the idea is to get new savings, these are the households that we need to think a greater deal about. They're the ones that we need to target. And we do have our hands full right now, because the current policy terrain that these families confront are clearly not working. So then the question becomes, well, what can we do? What would make a difference? What are some of the policies we want to pursue? And here, a few ideas and recommendations are in order. Some of which are mentioned in the report, some of which are reflected in some of our other work at the New America Foundation. Really, everybody needs an opportunity to save. Everybody should have access to some kind of savings plan. This should be a pillar of a savings policy that would be effective for all households. There's a lot of positive features that accrue when people have access to savings plans. You can try to keep costs down. You can limit the investment options. You can facilitate deposits with electronic transfers, direct deposits off payroll. So there's a lot of promise in looking at savings plan structures. We also know that a lot of people who interact with savings plans do so through their employer. So clearly, that's one area that we need to look at to make more effective. It should be a primary objective of getting more employers to offer savings plan options. And they're the ones that have the ability to use the payroll deductions to help make contributions. That's really an important tool. We also need to look at knowing that people have various relationships with employers, uneven work histories. There's got to be some other opportunities as well, and that's why we think that the tax filing process is an important opportunity. That can also serve as an infrastructure to help people make deposits into savings accounts. The next thing to look at is the structure of incentive. If we know that the current incentives that provide tax credits or deferrals aren't working, we need to look at what some alternatives might be. So there's two promising approaches. One is increased use of refundable tax credits that work for families even when they have low or no tax liabilities. And another is to avoid the tax code altogether and to look at how to match contributions to savings products. So used a matched approach, and there's some work that's been done in this area already that can be built upon. And the final kind of area where there's the potential for reform is really we need to have an eye towards limiting the complexity and maximizing the coherence of our savings policy. The goal should be really to streamline savings policy from its current form. Rules should be simplified. The number of accounts could be consolidated in ways that allow consumers to distinguish among their savings needs. Some need to save for long-term, like retirement goals, but other people have needs for intermediate savings goals, like saving for education, home ownership. These are the kind of investments that people can do strategically, and they form the bridge to a secure retirement. And right now, a lot of the focus, when we say savings in Washington, people say, oh, retirement savings. But here, there's a lot of diverse needs that people have, especially when they have lower incomes. And retirement is not always at the top of their list. So these are a number of kind of proposal areas that are out there that need to be considered. They should receive scrutiny going forward. And they really could improve the savings outcomes by a population that's missed by current policy. The issues that are embedded in the tax code, certainly linked to other areas of the overall system's efficiency and fairness. But when we look at the tax system as a whole, it's got a number of problems that need to be addressed, including raising revenue, sufficient revenue for government to do its business. But when we look at tax reform as a whole, when that begins in earnest, policymakers should really consider increased savings as one of the primary objectives of reform. So yeah, that's my kind of piece of the report. I'm going to turn it over to Work O'Brien, my colleague, to talk about public assistance rules and savings disincentives. Thanks.
So good afternoon. As Reed mentioned, my name is Rourke O'Brien. I'm a research fellow with New America, and I'm also a doctoral candidate in social policy at Princeton. So my students thank the Economic Mobility Project for scheduling this event on Thursday, because they were able to miss out on their Intro to Sociology discussion section. Although they'll have to make it up. And I also want to join everyone here in thanking the Congressional Savings and Ownership Caucus for sponsoring us today. And I really want to give special thanks to John Morton and the Pew Economic Mobility Project for giving us a chance to really kind of raise the visibility of savings, especially for low-income families, but personally for me to actually raise the visibility of asset limits as an issue. It's a problem of kind of huge importance but very low visibility. So I thank the Economic Mobility Project for giving us this platform for the report and the discussion today. So I'm sure a lot of people in the room kind of already familiar with kind of what asset limits are, so I kind of want to start from the beginning. So when you apply for public assistance in the United States, you typically have to demonstrate you're both income and asset poor. And the income guidelines make plenty of sense. We don't want people who make $50,000 or $60,000 a year to receive kind of welfare cash assistance. On the same vein, it's kind of understandable that we might ask people, how much do you have in savings? How much is your car worth? What kind of retirement assets do you have? And use that also as a guideline when determining who's eligible for what types of programs. And this was kind of a sensible policy that was put in the 50s and 60s to kind of make sure that we were kind of truly preserving these programs for those who are in need. What we found, though, in the last couple of years is that these rules have a really perverse impact of telling people that the government's actually going to penalize them if they save, with a reduction or loss of benefits. And that's had kind of very perverse impacts on how people think about savings and their daily economic behavior. So I first became interested in this topic about 6 years ago when I came across a few reports by economists who were kind of interested in this question of asset limits and do they really matter for savings? And using kind of large data sets, they kind of ran some regressions and basically concluded that they didn't see the poor saving at all, so these asset limits didn't matter. And that kind of struck me as not making much sense. One of the reasons why we don't see savings might be because these asset limits matter a great deal. So kind of eschewing kind of the traditional academic approach, I kind of avoided the large data sets and actually went out into the community and interviewed current welfare recipients. So I did that here in Maryland and Virginia in the winter of 2005. And I sat down with a bunch of women who were currently receiving TANF and asked them what they thought about these rules, what their knowledge of these rules were, and how it impacted their economic behavior. And across the board, the message was very clear. These rules are well understood and they do act as a perverse incentive. I had a number of people who were telling me that, that they had come to assistance before and were told that they had to spend down their savings account in order to qualify for welfare. And they said, no matter how much they pleaded that, I'm saving that for a car and that's important for, for me to get to work, it was still, you need to spend that down if you want to get on assistance. I had other people telling me that they continue to save, but they did so under the mattress. So they specifically avoided using banks or credit unions because they were scared that any kind of paper trail would make them ineligible for assistance. So here we have rules that are, we think, just serving to kind of preserve programs for the needy, but are actually inhibiting the mobility of these low-income families by preventing them access to small dollar savings and crucial assets. Beyond having rules against how much you can have in a bank account, asset limits also govern whether you can own a car and how much that car is worth, whether or not you can have retirement assets, whether or not you can have restricted assets such as savings bonds or college savings accounts. So it's more than just a problem of these people not being able to save in a savings account. It's more of a question of we're asking these people to liquidate their assets entirely before we provide them any assistance. So what does that do? That means they're on assistance for longer and they never get that chance to have that initial leg up that small dollar savings really can provide. So we from my findings, I kind of came to Washington and was lucky enough to find a home at the New America Foundation where I continued to work on this issue. And I had always done this from a kind of TANF cash assistance point of view. From my experience interviewing these low-income women and they telling me about their rules, and how it kind of affected their behavior. But the more I talked with other folks around town, I was finding that these rules didn't only govern eligibility in TANF, they also had the same perverse effects for the food stamp program, the Medicaid program, the SSI program, and so we're reaching a much larger population than just low-income mothers who would otherwise just be served by the TANF program. And so, so what this report here today is recognizing is kind of a synthesis of the last several years of conversations that we've been having here in Washington and with academics around the country about looking at a way to approach this problem as something systematic and affecting many more people than just low-income single mothers. So the idea here is that every program has their separate rules, and all the rules can be quite contradictory. In one state, you can be eligible for assistance if you have $5,000 in your bank account and a car worth $10,000. In the next state over, you have to have less than $1,000 in your bank account and your vehicle can only be worth $5,000. And then in the same state, that you might be able to have $5,000 in the bank account to qualify for TANF. If you want to get food stamps, you can't have more than $2,000. So this created just a very confusing set of rules that we were hearing also from plan administrators, just kind of made them just counseling low-income families that they should just not have assets because it just makes things more difficult. So what this, the synthesis, the analysis in the report is reflecting is this kind of new understanding that when we are talking about reforming asset limits, we must do so across the board. It doesn't make sense for us to just look at reforming these rules in the TANF program because 85% of TANF recipients also receive food stamps. 90% of TANF recipients also receive Medicaid. So if we're looking at just kind of doing one-off reforms at the state level, that's actually not going to make much of a difference on the ground. If you were to completely eliminate the asset limit in TANF, so the asset limit for these low-income mothers on that specific program, it's going to make no difference if we don't also eliminate the rules or change the rules in the other programs that serve them, such as food stamps and Medicaid. And this is kind of what's really new about this report and the arguments we're presenting today. And so kind of just one off, the details are in here, but just kind of a general sense of kind of the policy recommendations is we're calling for a standardized floor. So an asset limit that will be the same across programs. So that'll make things easier for both plan administrators and for recipients of public assistance, especially those who receive multiple forms of assistance, to understand the rules. There's some arguments for what that number might be set at. We think $10,000 might sound reasonable, but I think there are other places, other people that might argue that should go up or down. In addition to those, how we treat the actual money in the bank account, we need to go ahead and just exclude vehicles, first and foremost. That's the one asset that's actually been proven to help people on the climb out of poverty and to help people get long-term stable employment. If you can't have a reliable car, it's hard to expect people to be able to consistently show up for work every day. And then on top of that, we also want to send the right message that we want people to be future-oriented. We want them to be saving for long-term goals such as retirement and higher education. So we're calling for the universal exclusion of retirement accounts and college savings accounts, and other kind of restricted assets such as savings bonds as well. So we want to be able to encouraging people to be looking to the future, to be saving for those kind of long-term goals without worrying that at some point if they're going to need to turn to a public assistance program, they're going to be denied because they have been prudent and have been thoughtful in planning ahead. Those recommendations are largely for the population under 65. Once you get older than that, obviously, when you're looking at SSI, Medicaid, the rules get a little more tricky in how we deal with that. So those details are in the report. And I could talk about this ad nauseum, and I won't today, unless you want to ask me some fun technical questions in the Q&A. But I think the real take-home here is that these rules serve as perverse disincentives to saving. And they actually have a very strong impact on the ground. If we actually talk to some of these families, they'll tell you that knowledge of these rules is what prevents them from saving in the first place and from using banks and credit unions. And that's what leads them to use the payday lenders that Representative Cooper was talking about earlier today. So we need to have a thoughtful approach to solving this problem that kind of comes from the top at the federal level. The states have done a great job in recent years of using what authority they have to change the rules in these programs. But as long as families are served by multiple programs and multiple forms of assistance, we have to have a solution that is standardized across programs and comes from the top. So again, I want to thank the Economic Mobility Project for giving us this opportunity, and I look forward to a discussion. Thanks.
Great. So yeah, we do have a nice 15 minutes left here where we can have some exchange and some discussion. So I'll take some questions from up here. I mean, it's interesting that we have both a set of incentives that don't work and a set of savings disincentives that do work. And I think that exactly we want to switch around moving forward. Yeah.
I actually had a question just touching on what you were talking about, Mark. I'm with Nikki's office's office, and on Friday, more or less, we're going to introduce a bill to raise the asset limit of SSI, index to inflation, exclude retirement for the under 65, covered health. But we had this grand plan that we were going to raise the asset limits across the board and actually do a couple of things that you just said because it's so common sense.
Sure.
And we've hit a couple of issues, which is SNAP gets dealt with in the Farm Bill. God forbid you ask, ag to let go of that piece. TANF gets dealt with in the TANF reauthorization. That's ways and means. Like just the structure that we live in makes that incredibly difficult. So one, did you have a question? Did you have any comments on that? And the second part was, even for the under 65 population, SSI is a permanent program. They've got very different needs than sort of a temporary, or what we would hope to be a temporary program like TANF, food stamps. When we're talking about making those asset limits uniform, understandable, getting rid of the folklore that exists about what you qualify for, have you guys looked into sort of that divide between maybe your permanent programs for the disabled low income versus your temporary programs?
Sure. I mean, on your first point, I mean, I agree. I think this has kind of been a big problem is that we've done a good job, I think, of coming to the Hill when there were opportunities and getting people excited about how we can reform the asset limit in a specific program. So we did have a great success in the Farm Bill, the last Farm Bill, that we were able to exclude retirement and college savings accounts from eligibility for food stamps, as well as index that limit to inflation. We thought that was going to hopefully generate a buzz, but of course then everyone kind of moved on to something else. I agree, I think that is kind of the most difficult aspect of reform, but I think it shouldn't stop us from having a conversation that we need to do this in a coordinated way. Even if we end up having to kind of do it piecemeal in different vehicles, I think it's quite important that we see that this is kind of, all feeding into the same reform, and that it has to be done in concert for it to be effective. On the second part, I think it's interesting that asset limits, I think, affects persons with disabilities perhaps more than kind of any other population. And those programs are, perhaps by design, the most confusing out there. So it was kind of this population and this program that hasn't been brought into the conversation in a systematic way before. But if you think about it, it's kind of the same perverse incentives, the same problem with persons with disability when they are able to work. They're issuing retirement benefits for fear that when they need to go back on assistance, they're just going to liquidate the account anyways. Also avoiding bank accounts. It's the same issues. But the question of, it's a permanent program. I think there is a sizable SSI population that does come on and off. And I think that's kind of first and foremost. We want to make sure for those people who do work at some periods of time that they are able to take that opportunity to save both the short and long term. And I think that population is kind of forgotten about in our characterization of SSI.
Yeah, I really want to commend Representative Tsongas and the whole office for taking an interest in this topic. I mean, and I think that the approach you're taking is one that we're very supportive of. And I think that you'll find this report is really going to be a great kind of document to kind of march around and wave to people to draw attention to the work and the broad framework and the policy ideas that Representative Tsongas is promoting. So I think there's a nice synergy here between some of the ideas moving forward and the
She's
representative's
almost
interests.
as passionate as Laura.
Yeah, great. Well, that's what we've heard. We're very excited. Other questions? Yeah.
If you get these policies in for the vulnerable populations, how much of that $420 billion is going to move down to that end? Because we're hearing like, 70% of the subsidies are going to the upper 20%. I mean, it seems like there's got to be some type of a system where you're going to be more equitable in where those subsidies are going.
Yeah. Well, this is, I think, almost gets us back to the roadmap discussion, the previous document, and what they call the portfolio shift. And maybe, John, you could kind of weigh in on some of those deliberations and that concept.
Sure. I'll not speak to the savings incentive specifically, but more generally to the portfolio shift discussion that we led our group through. And again, to reiterate, our group are fiscal hawks and a very broad bedfellows coalition. Our recommendations, we believe, can be budget neutral and should be budget neutral in light of the current fiscal situation. And yet we believe that that can be done by better targeting existing expenditures. We believe the federal government does not spend too little money, but perhaps spends it in not sufficiently efficiently and targeted a fashion. And I think some of the examples in the savings arena are good examples of where funds are spent in ways that and the recommendations in this report go beyond those in the roadmap, but in ways which are which we could imagine seeing some savings cut from. So the $750 billion that was spent in the mobility budget in 2005, 70% of that goes to the middle and upper income families. If you are committed to upward mobility for lower and middle income families, you might choose to spend those funds in different ways. We don't make specific recommendations. We merely highlight the fact that there's a lot of money going to very specific programs now, and we show distributionally which programs are going where, and we pose the question: is this a proper allocation of resources in a fiscally constrained environment? And it's very clear which programs they are and where the distributional impact of those funds are. This report goes into more detail in the savings aspects, and I think poses the questions that, I mean, look, I think everyone in this room knows that Congress is going to have to make some very difficult decisions in the coming years with respect to resource allocation. And it is going to be hard to justify spending lots of new money. The question is going to be, where is the money going to come from? Our report states that there's no shortage of funds spent. It's a question of allocation. So
yeah.
we provide some good examples of where the funds are being spent and pose the question of where they might be spent in the future. That's an obtuse answer. You may have some more specifics related to the savings question.
It's a very compelling approach because it relies on a little bit of sunlight and first principles. I mean, you know, what do we want to accomplish? And so in the savings arena, if the goal is increased savings, you know, we want policies that generate new savings. And if we have policies that just are helping people kind of move money around, you know, well, that's a place where maybe we need the portfolio shift. You know, you could also move into other areas of you know, what other politicians have thought of as a third rail, the mortgage interest deduction, which currently helps subsidize mortgages up to $1 million in second and third and other vacation homes. And you know, maybe that's a place for the portfolio shift. Now, it's hard to get the politicians to weigh in on the mortgage interest deduction, but at some point we're going to need to look at our resource allocation more seriously. Other questions here? Yeah.
Does the tax expenditure estimate is that a net figure? I mean to say, does it take account of the taxes paid out of qualified plans when they draw income?
It is a net figure, but it's done on an annual basis. So it's the revenue foregone in that fiscal year. So you know, we have this wide array of vehicles, and some of the tax advantages are up front, some are at the back end, and so for like the Roth IRA, the hit doesn't come until later. So in fact, we could argue that it's going to get worse over time with the growth of the Roth IRA approach and tax-free earnings. So I think that, you know, the assessment is you know, looking at it from a current year. But the problem is going to get worse down the road. Other questions here as we wind up our hour? All right, well, I want to thank everyone for coming today, and appreciate your presence and interest and engagement on this issue. And please pick up material on the way out and visit us on our respective websites. Okay.